It's just like I told you about this one. So you just have to understand that under investment property, there are situations that arise which show that you have to be careful on whether to classify something. You find the part of thing is an investment property and part of it is an owner-occupied property. So you have to make decisions, right, on what to use.
Yes.
Yes, so that was all about the other considerations. So you just see that and you know that is what is intended. Okay. Investment property doesn't have much because it only speaks of land and building. So below are examples of items that are not investment properties. I think you explained already. I told you that definition said that unoccupied property that is per IAS 16. But obviously property intended for
Yes.
sale, we have also spoken about it, right? Yes.
Yes.
Yeah, that will be inventory because we plan to sell it. But also we're being told property being constructed or developed on behalf of third parties. Oh, this too is obvious. Maybe it's just a wake-up call. You just be careful. If you're developing a building on behalf of someone, that isn't your property, right? That's just a contract to develop.
Yes. Yes.
So just maybe say, okay, I'm developing something, people will pay me, I'll have to record the revenue that I earn from there. That's too is obvious. So a lot of things here
Okay.
just give you a wake-up call. You can see other definitions, just like yesterday, owner-occupied property. Owner-occupied property, I think we have even seen the example, right? It's just property held by the owner or by the lessee as a right of use what? Asset for use in
That's
production.
it.
Just like for PPE, use of production, supply of goods or services, or for
Yes.
administrative work, right?
Papers.
Fair value is the same definition we studied yesterday, but since we are speaking of assets only,
Yes.
we only focus to sell an asset. Cost is the same like what we did yesterday again at the PPE, right?
Yes.
Amount reduced to acquire something else, right? Carrying amount as usual. Cost, the figure at which to record something at an in the statement of financial position, which normally should be the cost and less whatever subsequent amount have to be deducted.
Depreciation.
Yes. And
Yes.
commonly and impairment. All right. So as I told you, the recognition criteria for assets for investment properties, you would find it almost the same to the I-16 property, plant and what? And the equipment. If you have an asset, you obviously expect economic benefit. And that's why you are confident of claiming that this asset is worth this much. Right. If you expect
Okay.
no economic benefit, it means if you have recorded an item in the book at a certain amount, that is wrong. You have just done it, but actually it's what? It's wrong, right?
So,
It means that it
yes.
should be impaired to zero. And that's why if you expect economic benefit, then we'd say it's fine, it works. So it should be probable that future economic benefits are expected associated with what is investment property will go to the entity, but also the cost of investment property should be able to be measured reliably. If you can measure it reliably, you can present the statement to users, right?
Yes.
And now let's go to measurement and finish up with the investment property. Now, as for measurement, it's the same thing, just like for what? Property, plant, and equipment. Initial measurement is the same. We measure it at what? At cost, or you can call it deemed what?
Cost.
Deemed cost, right? For example, let's say it says including transaction cost. Let's say, for example, we'll come and see about this transaction cost. And about this cost, it really depends on the method of acquisition. I gave you the method of acquisition yesterday, right? Buying
Yes.
something outright, through lease, government grants and what, a lot of
Yes.
things. So this cost could well vary depending on the mode of what? Of acquisition. That's why they also include transaction what? Cost. For example, let's say it's a right of use asset. Maybe you lease out a building. If you obtain the building through lease, we don't record the cost of that building as it is, right? We record it by something called right of use asset. We take the present value of the payment we expect to make to that entity, and then we get our right of use what? Right of use asset. So each standard or each scenario will
Yes.
have its own way of getting it, so that is not big deal, right?
Okay.
That's why they're telling you a right of use asset should be measured as IFRS 16. If you have leased it, you follow the leasing principles to know the cost, which is very obvious. And then let's go to subsequent measurements. You can now see things are the same. For subsequent measurements, you either use the cost model or the fair value model. Have you noted the difference to PPE, property, plant, and equipment?
Yes.
The cost model is the
For
same.
PP,
For PPE,
for PPA, they use cost model and
mhm,
revaluation.
exactly. And here, cost model
And
and fair
this one
value
is cost
model.
model.
The concept is the same. They both use fair value, but there's a difference. You remember when we were speaking of revaluation loss and revaluation gain. On PPE, we
Yes.
said revaluation gain goes to OCI, other comprehensive income, while loss goes to profit or loss. But for investment property, it is very simple. Everything goes to profit or loss. You see, it's very simple. That's why if you do that,
Oh,
yeah, here matters become just simple. And even for cost model, you have
okay.
nothing new to study. You see, the cost model is the cost. We just applied as 5 plus 16, right? For all the assets.
Yes.
Assets held by lessees as a right of use. The assets are measured at cost in accordance with the IFRS 16. That one I've said already, right? To know the initial, the cost of
Yes.
an asset is for those principles, right? So as usual, we would have to measure an asset at cost less depreciation and what? Impairment what? Losses is appropriate.
Losses.
Yes. So there is totally no what? No difference. Okay.
Okay.
What about the fair value model now? The fair value model too would be very simple because you just follow the revaluation model, but this one becomes simpler actually. An asset to be carried at its fair value at the end of at the end of which reporting what period. This is just like PPE.
Period.
Yeah. Under the revaluation model too, at the end of each year, we do what? Revalue the asset, right?
Marriage.
Yes. So we also do the same here. What is the difference now? That's what I want to speak of. First of all, under the revaluation model of I-16 PPE, we depreciate the asset, but for fair value model, we do not depreciate. You see how simple it is. So
Okay.
under I-16, we depreciate, but also the gain goes to OCI, other comprehensive income, and loss to profit or loss. But under I-40, it's simple. You don't depreciate, the simple issue, but also whether
So,
it's gain
so
or
I
loss.
have a question.
Okay?
So, in a question, whereas they combine the IS 16 and IS 40, whereas the IS 16 needs you to depreciate before you do the evaluation, and the IS 40 does not need that. So, how are you going to go about it if it's a mixed equation?
If it's a mixed question, you have to separate. You separate the cost. So one section you deal it as for PPE, and the other section you deal it as for investment property. Unless maybe you have made the conditions, those conditions above, which I say we spoke of other consideration, maybe you have to choose between them, right? The part that is insignificant, you may leave it out. But actually, it's no big deal. You know, saying that you leave the insignificant part just helps you to simplify accounting matters. But you may well follow principles for each. Each part can be treated as it is supposed to be what? To be treated. That issue of ignoring the insignificant part just aims at simplifying what? Your accounting. Right.
Okay.
Yes. And so here you can see an asset, as I've told you, it should be revalued at the end of each year. It's fine even for a 16. After initial recognition, an entity that chooses the fair value model should measure all of its investment property. This too is obvious. You remember, and I-16A, we said that if you revalue one item, the whole class to which the item belongs should be what? Revalued to avoid
Evaluated.
selective what? Evaluation, right? And now here, they are not speaking of the word class because investment property itself is a class already, right?
Okay.
It's already what? A class. So that's why they are not telling you, you know, and PP, we said we have the class of property, we also have a class of plant and what? Equipment.